Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Scott Choppin. Scott is the CEO and founder of the Urban Pacific Group of companies, a Long Beach, California-based real estate development company founded in 2000. They focus exclusively on workforce rental housing communities throughout California. And in just a minute, we're going to speak with Scott about multifamily opportunities for workforce housing in California. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we would love to hear from you if you want to leave a comment. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, we invite you to subscribe. With that, I want to welcome my guest, Scott. Welcome to CREPN Radio.
Darren, great to be here. Thank you for the invite.
You bet. I am really looking forward to our conversation today. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, we're like you said, we're based in California. I've been a developer, real estate developer in the real estate development industry in a career my entire life. I've never done anything but that. I have a family background. That's part of the reason why. Spent several years working professionally for major, national ranked real estate development companies. You graduated from Cal Poly San Luis Obispo in California with a finance degree. And after I worked professionally for a few years in 2000, we started Urban Pacific. So we're actually now, we're coming up on our 21st year of operations. This coming March will be 21 years. And as you alluded to in the introduction, we're specialized in urban infill housing and it's particularly workforce housing. That's in fact our sole exclusive focus as of about 4 years ago. And part of the reason we're based in California, that's a big need. But looking forward to doing workforce housing really for the rest of my career.
Got it. Well, there's a lot of things I'm really looking forward to talking about with this. And I guess one of the first things that to address, it seems like most people I talk with, there's this almost a repelling force from investing in California based on lack of return or tax structures, landlord not friendly state, tenant friendly state. And yet it's almost like you're running into the center and saying, here I am. I wonder if you could start with just kind of a little bit of a perspective on what you see as far as the market, and then we can dive into the particulars.
Yeah, I think the way you describe it is exactly right. Like California has the highest housing price marketplace in the United States, predominantly driven by our political environment, which is very resistant or anti-development and has been for really several decades, really since the mid 70s. We created Prop 13 and we created something called CEQA. And what that basically did is that created a arbitrary and artificial bottleneck and crimp on real estate development activity. So if you're a developer and you want to produce new housing like what we do, or any real estate development, you have to go through the governmental entitlement process. You approach the city council of the city your site is based in, and you have to get their approval. And the CEQA basically made it a really big effort to do that. And we had to take into account all kinds of environmental quality. CEQA is California Environmental Quality Act. And that just made it very arduous, and also it's subject to attack, right? So if neighbors or other developers wanted to derail your project, they have this legal pathway to do it, and very costly in time. And then Prop 13 is our limiting on property tax. So in relative terms, we have good property tax base versus, say, like a market like Texas, which has no state income tax but higher property tax. But what that ended up doing is that drove cities throughout California to, because they didn't have these property tax revenues, they had to seek out different avenues to produce income for their cities. And the main one became sales tax. And so there's a term called fiscalization of land use. And that basically is where cities were choosing retail projects because they produce sales tax, and were against housing because, at least in their logic, housing was a drag on budgets, not a help. Like, it didn't produce revenue. So anybody who thinks about California, they may not know these particulars as to why California is difficult, but of course it has that reputation. Lots of regulation. You talked about the landlord versus tenant friendly. We are fairly fortunate as a new housing builder. Right now, at least under the regulations for rent control, as an example, we have an exemption through the 15th year of when we start the project. We have 15 years that we're exempt from rent control. That may change. So we're certainly not indifferent to the legal maneuverings that are happening right now, particularly where we are in the economic cycle. Calls for rent control are increasing, and at the highest level that I've seen really in my career. But that makes sense in certain sense of because of income inequality, right? When income inequality becomes more and more divergent, you either look to crimp the market, right, via rent control, or you do what we're doing, which is to provide a naturally occurring workforce housing, meaning through market mechanisms we're able to produce housing that's affordable at non-subsidized or non-government, sanctioned or subsidized projects, like, artificially subsidized. And so it's a, sort of a capitalistic, naturally occurring affordable housing model.
So you're talking about workforce housing. Help me understand. Are you guys building multifamily? And when you say multifamily, is it what kind of a number of units are we talking about in a typical project?
Yeah, so people like, what we do is like pretty new in the context of, look, historically what the development marketplace resolves as a new housing. So definitely multifamily, definitely a rental product, right on Brad categorization. But our product type is called urban townhouse, or UTH, we call it for short, and that's a 5-bedroom, 4-bath townhouse row home style unit, meaning it's attached and units are next to each other. But you got a front door and you walk up and down 3 floors, and it's got a garage, right? And so that's differentiated from, at least in California, from most new housing, really all new housing, because most of that's stacked flats, right? You live in a 5-story building, and every floor is a different unit. You got people living above and below you. Because of the way we're able to facilitate the land purchases, the construction, meaning construction costs, and also the rental income stream, the way the rents produce income to the project, we're able to make it a viable, profitable model. Like in your first question, you said, hey, people can't make the numbers work. You didn't say those words, but people avoid California because, if you got to pay a high price, yes, you've got high rents, but a high price just increases your risk as an investor if you're acquiring an existing product. Versus if I go to, Columbus, Ohio, right, I can buy at a much lower per unit, but of course the rent's, lower also. So it's a trade-off, right? The risk is higher in a higher cost market because you have to invest more dollars of your investment to produce a given income, through the revenue stream of the rental income. So our model basically sort of takes account of all those different factors, and we figured out a way to thread the needle to be able to build in California, given all this government regulation, producing rents that are affordable to the families, predominantly working class families is our main demographic. We also serve roommate groups. And so the combination of all these different things basically makes this a feasible model. And many aren't, many other models aren't. Even value add is a difficult way to produce feasible profitable yields. And we understand that. Like, we're from California, but I'm a native, and my kids are fourth generation in California, and where we live in Long Beach. But because we came from that marketplace, Darren, and know it so well, and have been a developer here for so long, you just start to look at it and you go, okay, what is the mainstream market doing? Like, what kind of new projects are they producing, unit types, the market and demographic that they serve? And we've always been a company, and me as the main strategist, as the CEO, like, where do we go where everybody else is not? Where do we go where there's less competition? Of course, we need demand, right? But we also want to try to serve under supply. In the early days, for us as an example, we were doing urban housing. And in fact, the company name is based on, what our original product offer is. And, we still do that predominantly. But we were going into downtown Long Beach and downtown Los Angeles when people thought that was crazy. And so, like, the model of contrarian and innovation, and looking for uncommon and scarce offers and high demand locations is, like, very much our theme. So this UTH model is just an extension of that, but it happens to serve families, which is, a good social impact story as well.
So if I heard you right, 5 bedroom, 4 bath is kind of the model. Now, is that rented to one family unit then? Are you renting to multifamilies, renting by room, or how do you do
Yeah,
that?
so really, originally it started out as a single family, like one family living together, and we have several ways that we describe them. But the main way to think of it is these are multi-generational working class families. So multi-generational, basically three or more related generations living together. But we also are starting to call them multi-earner households, right? So in these multi-generational families, you might have, mom and dad, adult child, maybe younger kids of either the parents or the adult child, and then in-laws or grandparents. And culturally, and their family lifestyle has always been this way, right? They just didn't have a product in California and most marketplaces that served them as a renter family that also wants to live multi-generational. That's one of the unique characteristics of UTH. So we don't rent by bedroom, but what we do now do, and we had always anticipated and actually rented to roommate groups. We're still a market driven product category, so we have to remain open and generally flexible to who we rent to. Of course, normal good property management tactics and practices are part of our overall systems. But what we're finding now in the pandemic, interestingly enough, is that we have roommate groups that are, like, very unusual, meaning they're usually a little older than what you would typically find in roommates. So say mid to late 30s. They're often unmarried. And what's happened is their companies have released them to work virtually, right? The company said, look, hey, you don't have to come in the office anymore. You're, like, good to go wherever you want. And so what we're starting to see is what I call affinity roommate groups, meaning they were roommates in college and they loved living together. But of course, they went and worked, moved to their various cities and worked professionally and had to be in this city or that city, and they're separate. But now, because they're location agnostic, they go, oh, well, it's cool. Let's, like, be roommates again, and then we'll live wherever we want. They don't have to, live in a certain place because of a job or otherwise. And so what we're finding is we're attracting these pandemic roommate groups, because we're of our unit type. Like, if you have 3 or 4 or 5 roommates, your choices are a house, right, a rental house, or if you're looking for something new, and that's, like, more like a multifamily type lifestyle, we're really the only product available at scale. I mean, there's other people that do 5 bedrooms, but usually much smaller scale stuff. We're as best we can tell, the only developer that's doing multiple projects, throughout the Southern California region generally. And so we get these roommate groups who go, great, a 5 bedroom unit and 2-car garage and a laundry room and 4 bathrooms. Like, that's a big deal, having 4 bathrooms, as you'd imagine. And then I'll finish with this final point. A lot of these roommate groups, what they're doing, Darren, is it'll be 3 roommates and they're renting the unit amongst the 3. And then they use the 2 bedrooms that are extra as their work from home space. That's not anything we ever could have anticipated. I mean, we've started this 4 years ago, as I mentioned before, and we knew that in a recession, a downturn or some disruption in the marketplace, that we would be a product where people move to defensively, right? Families, particularly, they go, oh, hey, kids are moving home. Hey, we want grandma to come live with us, and then they start looking for a unit that can fit that new, like, reconstituted or recombined family, which happens naturally in a recession, right? People get defensive. They share, the economic share is the style we call it. And so we anticipated an acceleration in our business plan in a downturn. Like, we always knew or anticipated that that would be the case. And it's been, now with these roommate groups also added to that, way more accelerated than we anticipated. Good thing.
No, it's fascinating. I always, or I shouldn't say always, but most often when I speak with investors, they're looking for, I think, a two-bedroom unit's been kind of the ideal. There's always been especially in larger multifamily rental projects. I've always kind of, it's been inferred. I don't know if it's been stated so much, but the larger units were less desirable. It was more of kind of like a two-bedroom was ideal, one beds if it was the right market. I mean, there's a right market for a one bed, but the larger units didn't really appeal unless I guess the exception would be like if you were in like a student housing thing, kind of like what
Right.
you were saying, the affinity groups. Um, I'm curious, how did you? What were the thoughts going into to recognizing that was a mix that was needed?
Yeah, great question. So a couple different answers. So my background in the professional companies that I described to you, one of them was called Kaufman and Broad Multi Housing Group, KBMH for short, and I worked there for a guy named Mike Austin, and that was a subsidiary of what people now know as KB Home, right? Subsidiary of a big national home building company, but that division built apartments, like new construction, real estate, apartment development. It happened to be utilizing something called the Low Income Housing Tax Credit Program, or LIHTC, which is a true affordable, government subsidized, housing, development style or model. And one of the things that we did at the time when I was there, which was sort of the mid 90s through 2000, was at that time, there was a trend towards building much bigger affordable housing apartment units. Like, we did a lot of 4-bedroom, like the affordable is either family or senior. Those are the product categories, always apartments, always rental. And the family projects, for a period of time, we did some units as 4 bedrooms, or like a few projects we were involved in were actually all 4 bedrooms. And the interesting thing I always remember, and it sort of carried with me, was that the 4 bedroom units were like in huge demand, right? Like, the families that needed them, it was such an unusual product offer that when people found out about it, they were like coming out of the woodwork. And so we were always way oversubscribed of applications to rent those units versus the units that we had available. Now, these projects had, 3 bedrooms, 2 bedrooms, 1 bedrooms, right? Rarely studios, to sort of, give a appropriate, protective or risk mitigated, mix of units. So you weren't all in on one particular unit type. But I always carried with me, like, those units, like, we would get them and it just was insanely oversubscribed, right? So coming forward to about 2016, we were finishing up a series of projects that we had started at the beginning of the recovery of the 2008 recession. So I think around 2011, 2012, started back up development operations. And at the time, the product category that was, that was in vogue was what we call a podium building, urban style products. Think, 4 or 5 levels over a parking structure below it, right? Cars parked below in a garage. That's a podium. And the mix was studio and 1 bedrooms, right? Like, all that was it. There's maybe a little bit of 2 bedrooms here and there, but really it's predominantly studios and ones. Well, that was reactive to the demographics that were accelerating at the time, which was millennials predominantly coming out of the, living with parents, getting their first job, coming out of college. And of course, they wanted to, get the cool unit in downtown this or downtown that, right? Urban housing close to cultural
Yeah,
amenities.
almost the micro housing was kind of big trend there for a
Yeah,
little bit.
that was inside there. I mean, we didn't
Yeah,
do that, but you're right. I mean, that
yeah.
was in the mix of that, and that came later as affordable, as rents went way up in these markets. They became so expensive that your 1 bedroom unit would far out, like, out costed people's ability to pay, generate the income to pay the rent, right? And so in 2016, we finished up a series of deals, did, really well, bought well in 2012, 2013, developed them, finished them. We're really like the early phase of this demographic trend in this, studio and one bedroom product, right? And at the time, late 2016, a couple things happened. Debt and equity sort of at the same time, at least in our markets in Southern California, pulled back, right? They said, oh, we're not going to lend so much. And if we do, we need a lower LTV or LTC, the lender said. The equity guys said, hey, I need better returns, in parlance, it was a higher NOI to cost, right? More income generated given a dollar of cost. They said, you got to find us, projects that produce more income relative to the cost to build it. Of course, that's like, you can't turn around and just find deals that are like cash flow better in the development model because everybody wants that. That's like the holy grail. And so really, we sold. So we had a gap in our business plan to say, look, like we can start to think about something different or new to be able to do here. And we didn't know what that was going to be. But I started work on some various projects, looking for land that was, new opportunities that could be bought. And there was one particular piece of ground in downtown Long Beach where we're based that the city was selling, right? The city owned it. They were going to do a housing project there, decided not to, and it was for sale. And we bought it really well, like 45,000 a door, which in California at the time was really cheap. Already zoned, didn't need to do any zoning. But it was interesting because we took that project on and bought it because we bought the land so well. It gave us this capability to experiment. And the experiment turned out to be on that project that we had a limit on the unit count, but not a limit on the size of the unit, right? The zoning you know, didn't go into the size of the unit. We said, hey, you can get so many units on this property. So when we figured that out, as we're in our due diligence, I gave instructions to the architect. I go, okay, we can't do more units, but we can do bigger units, right? He said, yeah. And I go, well, like, what could we do? And so we debated on this 3 or 4 bedroom model. Could you do that? And would that make sense? Does that, I've never done a 4 bedroom market rate unit in my life, right? It's totally just, anathema to, the market trend at the time. This is about 4 years ago. And so we basically settled on a 2-story townhouse style unit with 4 bedrooms, 3 baths, and a 2-car garage, in-unit laundry. And basically, closed on the land, built the project out. And then at the time, our early phase of the UTH business plan, we're going to sell all the projects, just, finish the apartment buildings, lease them up, sell them, right? Monetize the value add through the development process and move on to the next one. So we sold that building to a buyer who didn't want us to fill the units. They said, no, we want to pick our own tenants. And they were willing to pay us, basically full market price. So we said, great. And we had at the time, Darren, been underwriting those 4 bedroom units at 2,650. And, we had been monitoring the market, but hadn't seen any particular trends that
2650 for monthly rent.
for a monthly rent for a 4 bedroom, right? 2,650. Well, we sold it, and that buyer turned around like the next day and put the units out on the market for 3,250.
Oh,
And we're like, I called the investor in the deal, as our partner / investor. And I go, what did we miss? Like, what is it? And so they ended up running some of the units at 3,250, another of the units at 2,950, but either way over our pro forma. And so this was a real eye opener. We're like, we knew the product was differentiated and it was special and unique and sort of a new offer in the marketplace to renters, right? Particularly. What we couldn't have anticipated, although we knew we had a solid offer, was that the rents would be that high, that families who wanted to live in that unit would have a willingness to pay those higher rents. And so this really opened our eyes. We go, maybe there's something here. So we started looking at other sites, designing more site plans. We ended up changing from a 2-story 4-bedroom to a 3-story 5-bedroom. We sort of got into the story. We go, oh, well, if we're as good, maybe more is better, right? 5,
right.
6 bedrooms, good. So we settled on a 5-bedroom product because that's what we could fit in a 3-story unit, right? So we shrunk the footprint, went up a story, and that allowed us to do more units on a given piece of land. We basically increased the density by going to a 3-story model. And so from there, that 5-bedroom unit that we explored and then sort of solidified became really our go-to product, so that we do that same unit. Basically, in every project that we do, we only do these UTH 3-story townhouse units. Now we're starting to add, maybe if we got a little bit of extra land, we'll do a 3-story 2-bedroom unit. we're starting to do what's called ADU, or accessory dwelling units, where we can take what would have been a garage and make some rentable space out of it. Under California law, that's allowable. So we're juicing the density a little bit, helps us on the returns, fills the projects out a little bit more from a design standpoint. And so, just to finish up the point, we did 4 projects in the beginning, what I called the demonstration phase. We wanted to test the model because basically nobody had done 5-bedroom units like at scale, right? It was an untested, it was an experiment, right? So I said, let's do, a series of projects that, weren't big projects. If they failed, we'd lick our wounds and keep moving. But this experiment gave us capability to learn about the product, how it rented, what it cost, and what it valued at when we sold it or refied it. So by the time we got to the 4th project, we were solidly profitable. In fact, we basically, over that portfolio, the first 3 projects that we sold, was 22.6% IRR on about a 2-year investment period.
That's
And
solid.
solid rental history, great demand. In fact, the rents in that 4-year period have gone from about 3,000 a month, was our next deal to underwrite after that first one I described, and we're now right now at about 3,500 a month. And interestingly enough, during the pandemic, continue to lease units to families, but also these working roommate situations that I described earlier.
So let me ask you. So I get the unit makeup. In a particular project, how many units are you putting in any one project?
So in the beginning, it was small. Like during this demonstration phase, we purposely stayed small. So at the time, the units ranged from 2 to 15 units, and particularly the first 3 were all very small. We intentionally, I'd never done anything that small in my life, but I also said, look, if this thing screws up, I don't want to be owning, a bad project. And so as we got, more proof of the model, the projects got bigger, right? In real estate development, it's always better to do bigger projects. There's more efficiencies, there's more capability to spread fixed costs across a larger project. So right now we're ranging between basically about 15 and 85 units is our now what we're in the production phase. So we've moved out of the demonstration phase. We completed that experiment, called it successful, proved the model with the returns that we generated, sold them successfully, got the values that we anticipated, happy buyers, happy investors. And so now we're carrying it on to, we now are up to our 8th and 9th projects in this series, this UTH business plan. And they're, continuously getting bigger. And we don't see any limit at this point in time to the demand in the marketplace for this product categories, because we're in California. We have the highest priced real estate rental market, particularly, but also for sale. And incomes are stagnant for middle income families, and so you got incomes here, and you got housing price there, and particularly inflation's coming, we believe, from the stimulus. Housing production's not picked up. In fact, if anything, the pandemic squelched the development pipeline for a period of time. So we've even exacerbated our supply story. And so we're long run, look at a 5,000 unit portfolio of UTH projects that we're going to hold long term. So all of our capital raising efforts are now for basically 6 to 10-year periods. Like, we want to hold these long term for
Did you,
2
did you
reasons.
say
One,
5,000 units is what you're going for?
5,000 units, yeah.
Okay.
And that would be predominantly California. So we're in Southern California, LA and Orange counties. We moved to San Diego next, Bay Area after that. But this is a model that we've done test underwritings in Portland, Seattle, and Denver. And this product works in all those markets. And in fact, we're, in a story a little bit about, extending even further east, maybe into some of the higher density, metros and places like Texas. I mean, we have to be in major urban metros. This is not a suburban product. This is not a rural product. We have to be in that place where housing costs and incomes have a gap. Maybe in all markets they have a gap, but some are, this much. We're this much in California. And even in California, as we go out to further outlying areas like Inland Empire, Riverside, and San Bernardino counties, the model doesn't work because basically, rents drop, although the cost to build the unit on per square foot doesn't drop to the same degree as the rents drop, right? Demand
Right.
characteristics are
Just demand.
different. There's more available land. Land is cheaper. So, our high density really in the city model. And we're not in like downtown LA or downtown Long Beach in the middle of the city center. What we are is what I call urbanized suburbs. So there's still a suburban model, but there may be two or three or four neighborhoods outside of the central business district in when you drive around it, and a suburban community, right? It's like, single story retail and the gas station and two-story apartments and some single family homes. Like that's the mix. In fact, vast swaths of Southern California are, that way. I mean, people call it sprawl, that's suburbs, but it's urbanized in the sense that it's not the, master plan community suburb that most people, I think mentally envision when they think of suburbs, but yet these are still suburbs. Now, in Southern California, it happens to be that the predominance of people that are middle income, middle class families, working class families live in these neighborhoods because this is where they can afford housing a little less expensive because you know, it's not new or it's in an older neighborhood. But also, interestingly enough, we've seen in amongst our tenant base that the commute range is 10 to 20 minutes. So these are not families that drive, 1 and 2 hours, and people do it. I mean, we're Southern California, we've still got, traffic jams like nobody's business. Although under the pandemic, that's, been relieved a little bit. But the reality is these families, they pick the housing coherent with their job location, where their kids go to school, where their extended family may be, churches down the road. Historically, maybe they lived in that city and they just are looking for a different unit to upsize because their family's growing either through recombination, meaning kids moving home, or in-laws or grandparents moving in, or they just need to upgrade. And then we do import some people out of market, like the roommate groups would be predominantly that.
It's fascinating. I was talking to somebody a little while ago, and we were talking about this was I think it was in Texas, kind of a rural area, and there,
Mhm.
it was common for people to drive 50 to 70 miles to work one
Yeah.
way,
Yeah.
and I was like, wow. I mean, that's just a totally different mindset from a
Yeah. Well, and
maybe
they don't have to worry about traffic. Obviously, they're driving on,
no,
highways.
but just a quality of life. I mean,
Yeah. Mhm.
um, I mean, I don't mind getting behind the wheel and tootling down the road if I've got something to listen
Yeah.
to, phone calls I can make while I'm
Yeah. But
driving or something.
70 minutes every day
Yeah,
is the point.
yeah, on occasion, I wouldn't want
Yeah.
to have to make that my twice a day kind of commute. Um, a couple of questions I've got. So the unit footprint, can you tell me how many square feet do these 5 bedroom, 4 bath units average, and then what kind of a ground footprint do you need to build a unit on?
Yeah. Great question. So the units are 5 bedroom, 4 bath, 3 stories on average, about 1,750 square feet. I've never done the math of each floor, but you can divide that 1,750 by three and you get your number. Unit footprints about 21 to 22 feet wide by about 35 feet deep. Like that's our standard footprint.
So
And
these,
that's
I mean, you could do these on like a standard, like a 50 by 100 lot. You could squeeze two, I mean, like a duplex kind of thing. So if you
yeah.
had a couple of those, you could go quite a ways, right?
Yeah. In fact, in that demonstration phase, and actually we're in a series of mid-sized projects right now, sort of like, pandemic, nimble, I call it. And they're all on these like 50 by 100, 50 by 150, 60 by 150. In fact, our internal design criteria is we're not going to do a site any less than 50 feet, because basically 50 feet is what you need to like comply with the setbacks for the zoning and the unit, and then a driveway, because all of our units have a two-car direct access private garage. You have a driveway that goes into each unit on the ground floor into that garage. And so this format of 50 feet ends up being the minimum. So on the bottom floor, it's a garage, two-car garage. In fact, the 22 feet really is driven by the width of a garage, which
Right.
is usually 20 by 20 standard for a two-car garage.
Got it. And then, so what is like I guess a uh, 2 bath apartment rent for in the marketplace that you're in?
So like I'll answer your
Just kind of a
question
range. Yeah.
slightly different. So on average, you could say the market's somewhere between 350 to 450 a square foot.
Right.
for any unit type. And so we show up in the marketplace and we're at about $2 a foot, just to give you a sense of the value proposition that we offer to the tenants. Now, the whole dollar rent is bigger, right? But it's also generally shared between this multi-earner household. So usually we're 3 or 4 or 5 earners in a household, which any earner on their own probably makes, 30 to 50K a year, depending on their employment, situation in the industry. And so by themselves, in fact, this is the statistic you always hear in the media. They go, oh, it takes, $57 an hour to afford the average 2-bedroom unit and I'm making those numbers up. Those aren't the real
Right.
numbers.
Right.
And you go, of course, and it sounds awful, and it is awful, right? Affordable housing is a real issue. But this economic sharing, this sharing of costs and incomes over the family group is culturally a very classic. In fact, historically, most of the people in the world still do live that way. And historically, we live that way, right? And it's sort of was lost, right? The nuclear family was anathema to, multi-generational living. But it's definitely returning. In fact, we're at a 160-year high of families living multi-generationally. I don't know how they went back 160 years to find this, but somebody did the study. I think it was Pew Research, and we went down, down, down on multi-gen living and sort of got flat like a few years ago, and then we're actually starting to grow back, meaning more families. There's growth in families that are living multi-generationally. And that's really important because if you look at poverty rates, and particularly in California, we have high housing costs, right? High rents, right? Stagnant incomes for middle income families. Well, those families are under ever more pressure to afford a nice house, right? The housing cost is inflated and their wages are not, right? It's a terrible position for them to be in. But when you start to think about them sharing, right, living multi-generationally, the poverty rates amongst multi-generational families drops dramatically. And that's not something people speak about in the mainstream. Like you never see that in the mainstream. I don't know why that is. It's just not something that they're focused on. But through what we've researched through recessions, and also just when the opposite of when markets are peaking, right? When we're at our highest housing costs, this multi-generational model really is good in both environments, right? So in a downturn, where employment's disrupted. So if you've got 5 earners in a household and somebody loses their job, the family can sustain, right? They've still got 4 incomes to live off of, right? In a high peak housing market, when housing cost is high, well, now you've got 5 income earners to spread the load of the housing costs amongst those 5 earners, right? And of course, people will say, well, it would be better to not have high housing prices. And I agree with that. But the reality is our political system in California is what it is. We've been this way for decades. The housing production has been, undersupplied for, 30, 40, 50 years, right? We're not going to catch up with that anytime soon. And there's legal changes happening at the state level. There's a whole new generation of, millennials and Gen Z, YIMBYs, they call themselves, yes in my backyard, which is the opposite of no in my backyard, NIMBYs. And I think they're really doing some great work, and they're starting to change the legal landscape. But the reality is we still have these deeply seated political structures like CEQA and Prop 13 that drive, development decisions. And then we have a whole group of people who are like single family homeowners that, maybe, call them, baby boomers is the biggest demographic in that, who are just like, look, I got my house. I don't want apartments in my neighborhood. No, thank you. And so they'll be active against, somebody like us, a developer who wants to entitle a project and build apartments in their neighborhood. And in fact, from a business standpoint, we know this. And so we actually, part of the reason we love the UTH model is because our family demographic generally lives in working class neighborhoods. And so we go build in working class neighborhoods. Well, it has the natural effect of lowering our land costs. Land bases lower, but also the politics of these neighborhoods usually are welcoming. It's an empty lot in the middle of an older working class neighborhood. We show up to build and they're like, great, because you know what? People used to leave their junk cars on that site. And that's where the place where the couches always ended up that people didn't want. That was an attractive nuisance. And so we're resolving that issue. And then invariably somebody says, hey, what are those units you're building? Like, we want to live there, right? Now that they see there's an opportunity to rent a 5-bedroom. So we've very much focused on these neighborhoods that are welcoming or have the right political or zoning environment. that, are attractive. And then it happens to be that we're able to buy land more, cost efficiently as well. And that happens to be where our tenants already live.
No, I just love the whole story. I mean, from the standpoint of, you know, as we started the conversation about everything else I hear is, California is not a landlord friendly state and you can't get any cash flow and blah, blah, blah. And you've basically figured out the problem or the solution is to build a unit that doesn't exist that people want, that can through multiple income sources, the tenants can actually buoy their family unit
Mhm.
and provide more stability in the unit. And actually, then I would say, create better neighborhoods, longevity and stuff. I was going to ask you, what's the average stay of a tenant moved in your unit?
Yeah, so we're 4 years into this. So on the first three projects that we developed, we sold. So we're really about 2.5 years into this long-term hold cycle. But what I will offer you is sort of an anecdotal story. So we were meeting with a family office locally here in Southern California, meeting with two guys. The senior guy, he just couldn't figure this product out. He's like, I just don't get it. Would you put families together that don't know each other? Like, how do you do that? And like that's, he didn't say weird, but that he wanted to. And then the other guy was a younger guy and the analyst. And so the senior guy had to leave. We're finishing lunch, and the analyst stuck around, and the other guy left. And he looked at me, the young guy, and he said, I get this product. My family owns units like this. Now, they weren't 5 bedrooms, but they were older urban apartments, predominantly Hispanic families. That was the demographic they served. And he's like, my family has had units where this family's been there for like 20 or 25 years. Now, it's not the exact same family members, all there for 25 years, but it's like the core, maybe mom and dad, and then, kids would move in and move out. But he said they're the most stable tenant base we've ever seen. And so we had already identified that these families were our like, main focus from a demographic standpoint. And some of my background in the affordable housing days, we knew this. Because I mean, think about it. If you're a family that needs housing like this and you don't have other opportunities to rent it, one, you're going to want to capture it if it's appropriate and affordable, right? But also, I think it has tenants, um, self-select that understand the product opportunity, right? Like, we have some of our units that will rent to Section 8 tenants, and they're like 5 bedroom units for Section 8 never happens, is
Right.
never available. And so what they do is they're really, they're great tenants because they don't want to mess it up, right? They're like, this is a great, brand new unit, air conditioning, garage, multiple bathrooms, quartz countertops, like they're like in heaven. And I'm so glad to be able to be producing a product that's like has this reaction to people. They like, I didn't know 5 bedroom units existed, apartment units. In fact, when people come through leasing, we'll get families that show up and they're like, are these for sale? Because they're really nice. And this can't be rental housing. And our leasing team's like, no, this is leasing. In fact, if you want, you can move in here. And what's interesting is they don't like the two things. One is they say, we didn't know this existed, and because it didn't exist. So that's a highly attractive force. But also, I had always anticipated that houses that rent would be our main competition. Like if a family had their choice and they could afford either our unit or a house and they were relatively comparable and equal, the family would always choose the house, the front and backyard, the white picket fence. I mean, the American dream in a rental format, right? But it's interesting because the tenants, for the most part, the families, they don't rent houses. We go, so are you looking at houses? Our leasing teams want to find out what else they're looking at. And they're like, nope, we rent apartments. I mean, they don't say the words exactly like I'm seeing them now, but they look on, the apartment websites. They look on, Zillow is a good source. They look on Craigslist, right, to find an apartment that's local to them, that's appropriate and affordable. We show up in that stream of, research and thinking, and they're like, geez, this is like never seen this before, better go check it out. And that's actually perfect because that's one of the main aspects of innovation and creating uncommon offers for us. we serve tenants. We have to produce a product that's attractive to tenants in the marketplace to move in and pay rents in our properties. But the second and main, customer we serve is investors, right? And the beauty of UTH is that you get to pair investor capital up with these very, steady, sustainable tenants who want to stick around, love the unit, will occupy it virtually forever. I'll tell you, we've had really zero collection issues during the pandemic amongst the small portfolio of units that we were had rented and were occupied managing at the time. And I think
I
it's
think
just
that
it's a
from a
testament to people really want to keep these units. And we don't think we're bulletproof, by the way. Like, we don't sit around and think we can just do whatever we want. Like, we got to continue to work to innovate and serve these families and these roommates group appropriately. And that's going to benefit us and investors as well, right? That's going to serve to create more sustainable income streams, better rents, better values, right, in the properties when we do refi or sell them. So all that, serving the family and the tenant serves the investor also. That's the beauty of it.
No, I love it. As an investor, having the multiple income streams. I mean, the tenant has multiple income streams to, you know, keep them afloat in difficult times, and just an inviting place that they end up staying for a long time. And I just think it's a great concept, and also new construction. I mean, I can't just stop thinking about the fact that it's all new construction to where you're, capital improvements,
Yeah.
virtually none. I mean, you basically just, once you got somebody in there, that you take care of any of the utilities. Is there any kind of trash or anything like that? Is there any kind of common lawn care or anything like that you guys have to
Yeah.
do?
So the way we orient is we want to shift all the utility costs to the tenant, right?
Mhm.
That they use at their discretion. So, and in California, you almost cannot have any units that are master metered anyways. I mean, it's not barred by law, but more and more the codes are saying you shall have this and shall have that, right? And so electric, of course, is separately metered, gas is separately metered. But what we're starting to do now, just to answer your question, part is we're starting to privately submeter all the water. So we'll have one water line that comes in to serve the property for the domestic use, landscape and the fire flow for sprinklers. But then we'll have a branch that serves each unit for its water supply, right? And then there will be a private submeter that goes in line on that branch line to the unit, and then we'll pair up with a company that supplies the private meter, does the meter reading, and then we'll build a tenant separately for their water usage. And then what we're doing is we're adding the sewer costs onto that, because in California, sewer is charged as a fraction of your water usage, right? And then trash, we're doing sort of like it'd be a RUB style calculation where the trash is prorated across the entirety of the project. And so, but other things are, standard lawn care, right? Like lawn maintenance is, that's landlord cost, insurance, property taxes. Maintenance is ours. But of course, as you point out, like, these are brand new units. And in fact, generally when we, are first occupying the building, we're usually most of the time falling under the subcontractor 1 year warranty period for whatever. So we're usually getting subs to come back. The door on the cabinets is loose and falling off. Hey, come back and fix it. That doesn't last forever. But we're definitely have a new product. So your life cycle is obviously very long, but also you've got brand new systems, right? So all the
Right.
plumbing is, to today's standard, which, we've all owned older apartment buildings, the plumbing clogging up in the showers, just notorious for that. And so we avoid a lot of those issues. We've got, fully code compliant electrical, right? I mean, anymore, a 1,750 square foot unit is probably pretty soon we're going to move to a 200 amp panel for an apartment unit. We're not there yet, but I think it's coming in California. One of the fun things in California is we actually now, as of this year, last year 2020, we actually now each unit has to have its own solar. So we used to have to put solar, conduit in for future solar. Now we actually have to install the solar like actual, right? And so in fact, our first project coming up that we'll do, full solar voltaic system in for the building. We'll be doing our first project here,
Hmm.
and all future ones for that matter.
Interesting. Well, I mean, that's an incredible project. I mean, just kind of that you identified a market that didn't exist, and that it's been so well received, and just the economics of it makes so much sense on all sides. I just applaud you guys for figuring it out and running with it. That's
Appreciate it. Yeah, it's I'm super excited, right? Because I've spent the majority of my career as a developer. I mean, developers are notorious for following each other, sometimes down the hole, right, into a recession. But we're seeing that right now, right? A lot of people are, sitting on brand new studio and one bedroom product, and perfectly appropriate when the market was good and peaking. But now that the market's reversed, and I mean, some of the stuff we could have anticipated. We couldn't have anticipated pandemic causing people to move out of the city of San Francisco at such a rate that the rents have dropped 27%. I mean, that's a black swan event like that can't be anticipated. But so such a peak already, right? Even if you couldn't know what the black swan is, you go, it's very exposed and very vulnerable and fragile, right? The market is, and this is one of the lessons we learned from the 2008 is that you don't want to be fragile when there's a lot of competition amongst other projects and product type and unit types. And this is one of the reasons why we created UTH as a 2016. This gap I talked about, we specifically said we don't want to do what everybody else is doing. In fact, part of the flat spot was that developers were flooding into markets in California, Southern California, and they were doing the same product, and the demographics were there. But where I went with this, I go, at some point a recession is going to come. We know it's going to come. We don't know if it's in a year, 2 years, or 5 years. But whoever's the last few projects into that market with that product where everybody else is doing that product, the early guys all leased up and they can play with their rents and that kind of stuff. But it's the last guy in the new development marketplace that get crushed. And then also the small and mid-sized developers get crushed because the big guys can sustain rent decreases, for longer than the smaller guys can. And so that's just we looked at the marketplace, we see all this product coming online, and we just go, we know it's going there. We're not in a bad mood about it, but we just say we choose not to be competing in that place, and that's part of the marketplace. Let's go somewhere else. Now the trick is to find the somewhere else that's viable, right? Because sometimes markets are, undersupplied because there's no demand. In fact, that's in the early days
right.
of UTH, investors would be like, well, gosh, you're a great product, and you're the only one doing it. You have no competition. That must mean there's no demand.
Right.
And we're like, no, in fact, it's the dead opposite. We're serving a marketplace that's never had a new product. Like these families have never had a new housing unit ever. Like we've got
Right. And
families that have never lived in a new unit ever in their entire lives. And it's like a miracle for them, Darren. It's like, wow, they don't even know what coarse countertops is. I mean, they're good people, but just never had that option or opportunity. That's such a great, just the social impact characteristic of alone. I mean, we're, based on a certain set of ethics and, ways that we want to approach helping people. And this falls like so much into that. We didn't know it would go that far when we first started the idea of UTH. We knew we wanted to serve middle income families, of course. But it's just turned out to be such a great, feel good story. And that's why, in fact, what I said earlier, I'll do it for the rest of my career. We're doing nothing but this. Like I've stopped doing any other type of development. We'll only build this kind of workforce housing or some type of workforce housing, at least for the rest of my career. And then, hopefully my kids might, continue in the business and, extend that legacy further.
Well, like I said, I love the fact that you guys uncovered it and figured it out because I think one of the things that's probably, impossible to quantify and why others couldn't see it is how many times do you have a 3 bedroom unit, but you've got the equivalent of a 5 bedroom property like yours, but the people who are living in a 3 bedroom unit because I couldn't find a 5-bedroom unit.
Yeah.
Because I can
Yeah.
tell you
They're
lots of
overcrowded.
stories about that, and it's a mess,
Right.
because there's just not enough space for people,
Yeah.
and it's
Overcrowding is a huge
yeah,
issue in
yeah,
California. And I mean, it's like awful. The living conditions in those kind of environments are awful. And, that's a bad version, a negative version of economic sharing.
right. But
Right.
because the product didn't exist, there was a need there, but it wasn't recognized as a
Yeah.
need. It was recognized as a problem rather
Right.
than there was a need kind of thing there. So,
Yep. Exactly. Well, I
but
appreciate that.
yeah. Hey, Scott, if we could, I'd like to shift gears here for a second. Like I mentioned before we started recording, by day, I'm an insurance broker,
Mhm.
and I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if we can avoid the risk. If that's not a possibility, we look to see if we can minimize the risk.
Mhm.
And when we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk.
Mhm.
And that's what an insurance policy is. It's a risk transfer vehicle. And I like to ask my guests if they can look at their own situation, whether it be their clients, their investors, the tenants, markets, however they want to frame the question. But if they can take a look at their situation and identify what they consider to be the biggest risk.
Mhm.
And for clarification, I'm not necessarily looking for an insurance related
Right.
answer.
Yeah.
Um, but if you're willing, I'd
Mhm.
like to ask you, Scott Choppin, what is the biggest risk?
Yeah, no, great question. Like I mentioned before we began the interview, like real estate development, and you could say real estate investment really is entirely a risk mitigation. You called it minimize, so I would say squarely in the middle there. Really, at the end of the day, you know, investing and development are a risk. You like they require risk to be taken to produce these returns that we're describing, right? Always the trade-off. And so, really, where I've arrived in my career, where I am now, is to be risk mitigating everywhere we can. And so, like, I'll fill in the answer some more, but there's many places that we mitigate risk. But here's my answer: is it really around a philosophy and a style and approach to how you mitigate risk? And I'll give you an example of what I mean. And by the way, this risk mitigation is a fundamental tenet of our business. In fact, I would say it's probably the most important one because we have so many different exposures to risk in so many different areas, right? Market demand with tenants, interest rates with debt, return characteristics with investors, governmental agencies who oversee us, right? Talked about California, right? That's an increased risk. So when I was a young project manager, I worked for Mike Costa, and basically part of my job, the way I work with Mike and the way he had his project management team structured is, as a project manager, you basically were responsible for the full life of a project, from finding the land all the way through to completing it and handing it over to the asset management team after it was leased, right? And that was very unusual. Maybe call it cradle to grave, beginning to end, however you want to describe it. So what that did is that threw me as a young project manager into, like, you didn't have to find new deals if you didn't want to, but I was like incredibly ambitious to to grow my knowledge. I knew I wanted to be a developer, running and forming my own company. Like I knew that, intuitively, since I was 18. But what I remember was looking at land, and I had good teachers, but when I would look at stuff, it was everything I could make it work. There was no project that I looked at that I couldn't figure out or thought I couldn't figure out how to problem solve, right? There's no deal I can't figure out. The hairiest deals with environmental issues, tough neighborhoods, tough cities, whatever, right? I go, oh, I could go in there, I could figure out a way how to do it, right? And what I figured out, dawned on me years later, is that by having that approach, I took on an incredible amount of additional risk. Now, when I worked for the company, it was their risk, and of course, they were smart about it and only gave me so much, rope to hang myself on a deal. But when I got out on my own, I continued to learn these lessons, and now it's in fact exactly the opposite. There's almost no deal that makes it through the underwriting, right? And I'm in fact very fast. You can talk to our internal teams who bring us deals, people partners, and people who bring deals. Like I'll no, 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 no. And why that's important is because it's a philosophical approach to mitigating risk, meaning acknowledgement of a risk and a willingness to mitigate it and a willingness to say no if it's unmitigatable, right? That's for us, there's some risks that can't be transferred, right? The construction risk under a personal guarantee to a lender is not, I can't shift it to anybody else. In fact, it's funny, in the old days, we always used third-party GCs, right, to construct our buildings. And then in 2005, the market was really peaking and we had a hard time getting GCs. And we brought all of our construction operations in house, like our project managers, our superintendents, they all worked for us. We were became the default builder, if you will. And I remember a headhunter goes, dude, you don't do that. You have to shift the risk to the GC. And this is what I told them. I said, at the end of the day, I hire the GC as the developer and I give the bank a personal guarantee. I sit in between those two people, or those two companies. And if the GC screws it up, I still own the risk. I mean, it may look like I shifted it to him, and contractually I did shift the obligations of building the building. But if he screwed up enough, or in enough, time or money, like, it's going to flow back to me. So where I told this headhunter is, I go, look, yes, I'm bringing some of these risks in house, but it also allows me to control and get direct access to the field, to the subcontractors, to the owners of the subcontractors, because the GC that sat in between me, he had his own agenda. He had his own profit to increase. He had his own stories that he told the subs, and sometimes that was good, but if the person didn't have good ethics, or they were trying to, manipulate, which people do in that business, I mean, all business, I suppose, I found it to be incredibly, like, I took on more risk that I could then not even control, or I had to, like, go through people to try to control it. And of course, when they have their own agenda, they're not going to let me control it if it's against their agenda. So this is a way for us to control, really minimize that risk. We still took on risk, but by having that direct access, we minimize that. So if you take that story and then you apply it to every possible facet of the real estate development process, at every time we underwrite, every time we buy land, we build a building, we rent units, we're looking to constantly always look at it from the standpoint of, what if this fails? What if this rent doesn't achieve what we think it's going to achieve? Maybe we better look at it at a lower rent to be more comfortable that we've mitigated that risk. And why I say it that way is because people who are entrepreneurs are naturally risk takers, and you're, in most cases, your own worst enemy in that. In other words, you're a risk taker, you're built to take risks, and you do take risks. Then the job becomes how to take risks that don't blow you up. And that's your own learning. That's, in fact, networks of people around me that I use, that my teams internally. Like, I encourage people, like, dude, you got to tell me no. Or the famous saying I'm a great problem solver. I cannot solve a problem I don't know about. Bring me all the problems. Don't hide anything. Don't cover it up or try to, I mean, if I can help solve it, great, I'll do that. But I want everything fleshed out, because, when you then get all the full picture, it's then, I mean, our job as a company is to problem solve and mitigate risk. And we do that thousands of times in a deal every day, over, the 2 or 3 year life cycle of the development project. So I know that was a really long and winded answer, but it's really like, it's like having a mental model of how you approach risk, and you do it, every day in your business, as in your insurance and underwriting risk. But I would always advise, particularly people who are coming new into the business, to, like, hear these words. And, a lot of times people hear it and they go, well, I'm different, I can do better, I'm a better problem solver than these guys, and that's fine. But, like, know that risk doesn't go away just because you think that way. In fact, arguably, you increase your risk because there's stuff you don't see. You can't admit to yourself that you have blind spots and need help from others to go, dude, you missed that thing, better watch out for that, right? Got all kinds of vendors around me that, I'm like, dude, tell me, like, don't hide it. I don't like bad news, I don't like surprises, but, what I like worse is, bad news and surprises that, I'm late to the game on.
No, it's fascinating how you've gone from the guy that was just starting out and assuming you could solve all the risk, but you had the backstop of the company that had the controls to say no, whereas now you've kind of gone to more of the no. You're the front end no, but then you've also taken on more of the risk. But I'm assuming that based on your process and having the experience in bringing everything in, like you said, that control is really what has helped you, um, control the risk. Would you
Yeah,
say?
in that particular example, for sure. But other risks are mitigated. Just when we underwrite rents, like in this example,
Yeah.
all your investors and people in the multifamily, it's like the age old when you're a new person in the business. You go, oh well, rents are 900 for a 2 bedroom, but I think I could get 925, right? My location's a little bit better. I could do it, right? I'm like, no, I'm either gonna be below the market because I know I got to compete with those guys, or I give the same rent for better value. I got a bigger unit, I better be at the same rent as that smaller, that smaller unit mix down the road. Like when we underwrote our unit rents in the beginning, and we still assess them at every deal, we look for the most comparable single family rental house. And then we want to be $200 to $400 a month in rent below that closest comp, right? So if somebody saw it, they go, oh, I got this, of course, brand new unit always like sells nicely in that market, but they go, oh, but it's also below, this house that I'm looking at, right? If they did look at it that way,
Right.
always making decisions in that, like, call it being conservative, however you want to describe it. Because at the end of the day, if you make your 20 or 30 or 50, variable choices about rent and operating expenses and land costs and build costs and market cycle, interest rates, and you're conservative generally on all those. I mean, you could be so conservative that you kill the deal. So there's that.
Right.
But I'm not talking
Right.
about that. I'm talking about being marginally safer, right? So rent's 900, I'm going to be at 875, right? So it's still, there's a story there, and maybe got a little room to drop if I need to, and then you do that like in many parts of the deal as you can. Then that will set up is when you go do the deal, you'll still get clipped by something, right? Lumber goes up. Like right now we're in lumber, the lumber markets went up like triple in the board feet price. And I had a practice in our teams to always increase our construction costs 10% on a per square foot basis every deal or batch of deals over a period of time. We go up 10% just as a standard like inflationary increase. That might not be enough today if lumber's at 900 where it used to be at 300, but I think we can shape enough for the other hard costs and the other trades that either we give volume discounts because we give the subs a lot of work, but we'll massage that process. But we'll also say, okay, on this deal we learned this lesson, then we need to carry that over to the next one. So we actually have a database, it's a spreadsheet basically, of all these little lessons that we've learned where I go, oh, we missed the lumber, better, plan for that better. And sometimes that goes directly into underwriting, sometimes it doesn't. But the key point is that we are always continuously assessing the risk, looking for the increase in risk or the market to move against us. And then, that gives us enough time to shift. I mean, development's a long cycle business, right? 2 or 3 years until you're running units in most cases. I mean, markets could change dramatically in 3 years, as you can imagine. So we have to be, continuously vigilant, really is the way I talk about it internally.
No, makes sense. Hey, Scott, where can the listeners go if they'd like to connect or learn more?
Yeah, appreciate that. So for your listeners, I'll make this offer. If they go to our website, www.urbanpacific.com/ebook, you can sign up there and get our ebook, which is called How to Survive and Thrive in a Recession, which I think is a good topic in this environment now. It came from my lessons in the 2008 recession as a real estate developer and entrepreneur going through, really the worst real estate downturn, that I think has happened, even, worse in at least residential real estate than the one we're going through now. But anybody who's going to get into the business needs to understand that. And, really these are lessons of specific tactics and actions you can be in both to prepare for a recession as ahead of time, do some of that planning and risk mitigation that we talked about earlier, but also what to do when, it hits you, right? And maybe you are unprepared because that happens too. And so, it's got a lot of good lessons in there. While people are on our website, I would encourage them to go to our investor education section. Tons of videos, articles, blog posts that cover tons of broad categories of knowledge of how to underwrite deals, how to assess sponsors, a lot of work that we do in the economic cycle tracking. Like we have a whole set of practices internally about looking at the long-term macroeconomic cycle and figuring out where that's going, what are new trends, new innovations in the real estate development and housing space. So a lot of good stuff there. And then if people want to get a hold of us, go to the contact page on the website, and our entire team's email addresses are there, and you can reach out to any of those folks, including myself.
Awesome. Scott, I can't say thanks enough for taking the time to talk. I've enjoyed it, learned a lot, and hope we can do it again soon.
Thank you, Darren. Appreciate it.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.